Rough and ready is a nice journal question to see whether you really understand what you're doing in the statement of changes in equity, combined with the capitalization issue and a little bit of dividend withholding tax, which you have to calculate. It's a nice question to see whether you really understand. I think I asked it in a class test last year or the year before last year, I can't remember. And the students did not perform very well in this question because they don't really understand what they're doing. Let's start with a question and not with an answer. Usually that's the place to start. Ignore value-added tax. Assume a VAT rate of a tax rate of 28% and a dividend withholding tax of 20%. R&R was incorporated in 1998 and was listed on the JSE since 2005. The company specializes in selling camping and outdoor equipment, gadgets, and clothing. The company performed very well in the past number of years and decided to increase their African footprint by expanding operations to Botswana and Kenya. As a result of the amount needed to fund the expansion, they decided to reorganize their capital structure and to issue new shares. Extract from the trial balance as at 30 June 2017. Now let's just check. Prepare the journal entries to record the share transactions of Rough and Ready as from 30 December 2017. Journal narrations are not required. Indicate in each line item of the journal entry what financial statement is affected. So you have to give the statement indication. I don't have to tell you that. You should know that by now that you have to do the statement indication. So please do so. From 30 December, and then the journal entries to record the dividend transactions, and then lastly name 4 of the 7 overall considerations on which IAS 1, presentation of financial statements, are based on, which I'm not going to do. You can go back to your notes. Good. We had at 30 June, stated capital, 2 million ordinary shares. Compulsory convertible 8.5% non-cumulative preference shares, 100,000 R5.50 par value shares. Share premium. Compulsory 10% redeemable cumulative preference shares, 50,000 no par value shares. So that share premium can only be attached to one class of share, and that is our compulsory convertible share. So basically, the total issue or the proceeds on the issue of those 100,000 shares was 700,000 Rand. Now, share transactions during the 2018 financial year. On 1 July 2017, the directors decided to convert the convertible pref shares into no par value shares. Now, the question only wants the journal entries as from the 31st of December or the 1st of December. Now, what is important though is that you note what is going to be. I'll show you the journal entry, which should have happened on the 1st of July. I wouldn't have received any marks for that, but it's good that you know exactly what to do. And that is only to transfer the capital balance to a stated capital account and the share premium balance to the same stated capital account. However, what the important difference is that in the past, before 1 July 2017, which is the beginning of the current financial year, that 8.5% dividend was calculated only on the par value of the shares of 550,000. But since it became no par value shares, the total dividend will be calculated on the stated capital account balance of 700,000 Rand. So no par value shares will be based on capital balances. Par value shares, the dividend is based only on the par value, the nominal value of the shares. Important principle that you should understand and be able to apply. Good. So the board of directors converted 50% of these issued convertible pref shares into ordinary shares on 30 December 2017, the first date that you have to do the journal entry, at a price of 5 Rand per ordinary share. So the first thing is to determine what is the amount that we're going to convert, and the amount that we're going to convert is 50% of 700,000, which equals 350,000. And the number of shares that you're going to ordinary shares that are going to issue to these former pref shareholders is then going to be 75,000 ordinary shares. According to the minutes of the board meeting held by the directors on 31 December 2017, it was decided to increase the stated capital by issuing 1 million additional ordinary shares at R5.50 per share and to issue 500,000 new compulsory convertible no par value preference shares at R6 per share. So I want to raise 5.5 million rand by issuing additional ordinary shares, and I want to raise 3 million rand by issuing additional convertible preference shares. And then we want to use some of that money and we want to redeem the 10% compulsory redeemable preference shares at a premium of R1 per share. So there it is. We want to redeem that. Let's write it down here. Redemption. Redemption means we're going to pay them back. We're going to give their money back. So that was then equal to an amount, a premium of R1 a share. What is the amount invested by them in the company? 100,000 rand. That is what we're going to pay back. It is 50,000 shares. So it was 50,000 shares issued at R2 each. We are going to give them a premium of R1 per share. So the amount that we're going to pay them at the end of the day being 150,000 rand. And we need this share issue in order to fund this thing. You're going to raise much more capital than only the 150,000, but this is for the restructuring of your capital. All monies were collected on 31 March 2018, which is important. So that is the first date that we're going to pass something. The same date that the redeemable pref shares and the dividends on it were repaid. Good. So that is the date when we make payment. Amounts received from prospective ordinary shareholders were 5,775,000. So clearly, an oversubscription. We wanted to raise 5.5 million. And then there was an undersubscription of 10% on the preference shares that we wanted to issue. Now, we wanted to raise 3 million rand preference shares. So if there's a 10% undersubscription, we only raised 90% of that amount of 3 million rand. All the approved shares were allotted on 30 April. Dates are so important, guys, because we are doing journal entries. Very important that you do this in date order for the monies received up to the final application date. The underwriting commission, on the issue of the shares amounted to 130,000 rand and was paid on the completion of the share transactions on 1 May. Let's put the 1 May there also in a very clear color. 1 May 2018. It is the policy of the company to utilize distributable reserves to account for share issue costs. Important. Good. So firstly, what happened? We collected up to 31 March the application money. That is the first thing that happened. And we received 5,775 in ordinary share applications. So we debit. Here's just the conversion. Do I do the conversion with you? I don't think so. Yeah, the board of directors converted 50%. I just did the calculations. 350,000 on the 30th of December. Sorry about that. So we debited our convertible non-cumulative pref share capital account and we credited our stated ordinary capital account 350,000. Right. Now on the 31st of March, we have accumulated funds in the bank account to the value of 5,775 for the ordinary share application. So the ordinary share application and allotment account, 5,775. We only wanted to raise 5.5 million, so clearly there was an oversubscription of that amount. I just want to take this out because if I don't talk, then you're going to see that and you're going to tell me I've made a mistake. On 31 March 2018, again the same date, we also accumulated the 90% of the amount that we wanted to raise, the 3 million rand, in our bank account. So we debit bank and we create the allotment and the application account for preference shares, 2.7 million. Then, at the same date, we are going to redeem the preference shares. And the preference shares in our books was at 100,000 Rand. So the amount that we can get for the redemption, or the amount that we must cancel on the redemption, will be the cumulative preference share capital account to the value of 100,000. I cannot take out more than 100,000. However, I'm going to pay, it was 2 Rand shares, so I'm going to give them a premium of 3 Rand. So what am I going to pay them? I'm going to pay them 50,000 shares times 3 Rand. So out of my bank account, statement of financial position, I'm going to pay 150,000 Rand. Now that difference, the premium on the redemption of the shares, our policy is to utilize or to write it off against retained earnings. Statement of changes in equity, 50,000 Rand. Great. So the date that we're going to pay the capital back, we also have to pay the dividends back. And this actually is on the 31st of March. That date is wrong. 2018. of March 2018, we also going to pay not only the capital back, but also the dividends. So that would be then based on the 100,000, the actual capital amount, 100,000 times 10% for the period of 9 months, 7,500. Debit interest expense in the statement of profit or loss, and credit back 7,500 Rand. Good. At what date did we allot the shares? We allotted the shares on 30 April 2018. So at this date, 30 April 2018, we're going to debit the ordinary shares application and allotment account with a 5775 to take it out of the books. And we're going to credit our stated capital account, ordinary share capital account, with 5.5 million, and we're going to repay the excess application money received of 275,000 Rand. Then we're going to allot also this pref capital. So we're going to debit the convertible pref application and allotment account to take care of that one, take it out of the books. At this stage, the underwriter has to come to the party. So he has to take up the shortfall. And he doesn't only take it up, it's not just something that happens in theory, he actually has to pay into our bank account that shortfall of 300,000. And now I can allot the full 300 million and take the 3 million Rand to the compulsory convertible non-cumulative pref share capital account, statement of changes in equity. The question says on 1 May we have settled the underwriters commission of 130,000, and it's our policy to utilize distributable reserves for this purpose. So we're going to debit retained earnings for the underwriters commission, 130,000, and we're going to credit bank, we're going to pay that underwriters commission 130,000 Rand. Good. Then we've done the issue of shares. The second part of the question is all about the dividends. Now, on 28 June 2018, at the financial year end, the Board of Directors declared a final ordinary dividend of 55 cents per share after a time-based dividend on the convertible pref shares was declared. Remember, the redeemable pref shares is now out of our books. We've already paid that interest on the redeemable pref shares, but we still have to pay the dividend on the convertible pref shares. The company decided that 60% of the ordinary dividend will be paid by ways of a capitalization issue. The capitalization issue was finished by the 28th of June, but the cash flow only took place on the 15th of July. Now, obviously, the first thing that we have to work out is what was the ordinary dividend which was declared, because that is 55 cents per share that came into consideration for the dividend. The second thing is 2.2, and that is how are we going to settle the dividend? Now, we are going to settle 60% of that dividend that we've declared by ways of issuing additional ordinary shares. The other 40% we're going to settle in cash, but that settlement will only take place on the 15th of July. So for year-end purposes, as at 30 June 2018, we will have to create an obligation, a liability in our books for that amount that is due to the shareholders and that amount which is due to SARS for dividend withholding tax. Then they go further and say you can assume that 80% of the ordinary shareholders are natural persons and 20% are South African resident companies. Why do they tell me that? Because that's got an impact on both shareholders for dividends as well as dividend withholding tax. Because dividend withholding tax, South African resident companies are not subject to dividend withholding tax. Then all preference shareholders are natural persons. So that means on the full pref dividend that we have declared, 20% of that will be paid over to the receiver of revenue as dividend withholding tax. Maybe we should let's start with ordinary dividend. First thing that we have to do is to see how many shares came into consideration for the 55 cents dividend. Well, we started off here with 2 million ordinary shares. And then we have converted here another 75,000 ordinary shares. And then we have issued another 1 million ordinary shares. So the total number of shares which came into play here was the 2 million plus the 70,000 plus the million. So that gave us 3,070,000 shares. The dividend which was declared was 55 cents a share. So the total dividend would be the 3,070,000 multiplied by 55 cents, which gives us a total ordinary dividend of 1,688,500. That was the dividend which was declared. That is the amount which we're going to debit dividends / retained earnings with. Oops. 1,688,500. Now we have to see how we're going to settle that. We know that already, so we must do that right from the start. The total dividend was 1,688,500. 60% is going to be settled by way of a capitalization issue of ordinary shares. So 60% of that amount gives us 1,013,100. So stated, ordinary share capital is going to be credited with that amount of 1,013,100. 40% is eventually going to be settled in cash. Of that, we have to go and look how much is payable to the receiver of revenue for dividend withholding tax. 20% of our ordinary shareholders are South African resident companies. So 20% of 675,400 is not subject to dividend withholding tax. What portion is then subject to dividend withholding tax? 540,320. And that, based on that amount, 20% is payable to the receiver of revenue as dividend withholding tax, and 80% will be paid to the shareholders. So, once we have determined the amount payable to SARS, we can put it in the account. SARS dividend withholding tax, statement of financial position 108,064, 108,064. What is going to be shareholders for dividends? Guys, shareholders for dividends is going to be that amount of 135,080 plus this amount of 432,256, which in total give us that amount of 567,336. And there is our full entry. Let's have a look then to the convertible pref shares. What is the dividend that we have to declare there? Well, the convertible pref shares we have now established is a total of 700,000 Rand. Then, as at 30 December, so 6 months down the line, we've converted 50% of that. So 700,000 multiplied by 8.5% multiplied by 6 months. That is the first portion of that dividend. 700,000, 8.5% multiplied by 6 months, which gives us 29,750. The remaining 50%, 350,000, will then be due for receiving a dividend for the second part of the year. So times 8.5% times 6 months, and that will give you the second part of the year's dividend, 14,875. Then obviously we had the new share issue, and the new share issue was for this total of 3 million Rand. So 3 million Rand multiplied by 8.5%, and that allotment only took place on the 30th of April. So it's only for 2 months that they are going to come into consideration for a dividend, and that gives us 42,500. So the total amount of a convertible pref dividend, 87,125. So dividends, statement of changes in equity on the convertible pref shares, 87,125. They tell us all the shareholders are natural persons, so 80% will go to shareholders for dividends and 20% will go to SARS as dividend withholding tax.